Are T-bills still better than no penalty CDs right now? The answer may surprise some of you. Hello, Diamond NestEgg members, Super Savers, and course fans. I hope you're healthy and well, and welcome back to our weekly update. So, after we posted this video on the best CD rates for September last weekend, quite a few of you asked us for a follow-up video on the best no penalty CDs on the market currently. With that in mind, here are the 3 topics that we'll be covering in today's video. 1. What are the top 3 no penalty CDs we found for you this month? And are they really paying more than T-bills? 2. Which treasuries rose the most and which ones fell this past week? And 3. What are the expected yields for the upcoming week's treasury auctions? Let's dive in now, folks. What are the top 3 no penalty CDs we found for you this month? And are they really paying more than T-bills? Unlike traditional CDs, which charge you a hefty fee for early withdrawal before maturity, a no penalty CD allows you to withdraw your funds partially or fully during the CD term without a penalty, although some banks may have specific withdrawal windows, for example, after the first 6 days of funding only. We've organized our list of the best no penalty CD rates this month by APY, starting with the CDs that have the lowest APY and ending with those that have the highest APY. At number 3 is Marcus by Goldman Sachs. At the current time, you can get a 4% 7-month no penalty CD or 4.05% 11-month or 13-month no penalty CD. And everything appears relatively straightforward. There's a $0 early withdrawal penalty. You can withdraw your full balance beginning 7 days after funding. And there is a $500 minimum balance and a maximum allowable investment of $1 million per account. You can open the CD online. At number 2 is HEREIN. Unlike Marcus by Goldman Sachs, HEREIN doesn't offer CDs themselves. Rather, HEREIN is a digital savings platform that gives its customers access to CDs, high-yield savings accounts, and other deposit products through their network of FDIC-insured banks and NCUA-insured credit unions through their platform. Currently, on HEREIN's platform, you can get a 4.15% no-penalty CD, either for a term of 3 months from Mission Valley Bank, a term of 4 months from Ponce Bank, or a term of 5 months from Optimum Bank. And if you want to lock in your rates for longer, there's a 3.9% 12-month no penalty CD from Sky One Federal Credit Union. There's no early withdrawal penalty, and you can make a one-time full withdrawal 30 days after opening. The minimum investment requirement is $1, with no maximum allowable investment from what we could find. And you can open these CDs online. Remember that HEREIN is currently offering a new customer bonus. You can earn up to $1,000 with code EASY or EASY at sign-up. The fine print at the bottom indicates that customers will receive $75 for depositing between $10,000 and $24,999, $250 for depositing between $25,000 and $49,999, $500 for depositing between $50,000 and $99,999, and $1,000 for depositing $100,000 or more. Now, this extra bonus for new customers can actually be quite attractive. For example, if you're a new client and put $100,000 into this 3.9% 12-month no penalty CD with Sky One Federal Credit Union via HEREIN, you should earn $3,900 in interest for 12 months, plus the extra $1,000 bonus on top, which gives you a total return of $4,900 or 4.9% for the year. And if you know for certain that you will hold to maturity, meaning the no penalty withdrawal feature is not so important to you, you could even take advantage of this normal 4.1% 12-month CD from Consumers Credit Union. $100,000 into this normal CD should earn $4,100 in interest for 12 months, plus the extra $1,000 bonus on top, which gives you a total return of $5,100, or 5.1% for the year. Too bad you can get the new customer bonus only once. To qualify for the bonus, your first deposit must be initiated between August 1st, 2025 and September 30th, 2025 by 11:59 p.m. Eastern Time, and the promo code EASY must be entered at the time of sign-up. Only funds deposited within 14 days of the initial deposit date and maintained with partner banks on the HEREIN platform for 90 days will be eligible for this bonus. And check out this best CD rates video from last weekend in the first pinned comment below. If you don't need the no penalty feature, you may be able to find some even better rates there. But back to no penalty CDs now. At number 1 on our list is Climate First Bank, which is offering a 4.34% 6-month no penalty CD. There's no early withdrawal penalty after the first 6 days of funding. The minimum investment requirement is $500, with no maximum allowable investment from what we could find. And you can open the CD online. Climate First Bank was founded in 2021, headquartered in Florida, and according to their website, it is a full-service bank with a laser focus on environmental sustainability and doing good. Now, the top no penalty CD rates that we've shared with you today are better than where similar maturity T-bills are at the time of this taping. But do keep in mind that if you live in a high income tax state, it may make sense to compare the CD rates you're considering with Treasury rates, because interest earned on CDs is fully taxable at all levels, whereas interest earned on Treasuries is only taxable at the federal level, but exempt from state and local taxes. Please also note that all of the CDs that we've talked about in this video are FDIC or NCUA insured to the best of our knowledge. The FDIC and NCUA insure individual accounts at banks and credit unions respectively up to $250,000. I've linked these two videos in the first pinned comment below for those of you who want a deeper dive into how FDIC and NCUA protection work. So, now that you know what the best no penalty CD rates are, let's move on to the next section of today's video and see where Treasuries ended the week. Which Treasuries rose the most and which ones fell this past week? Here's our usual table with Treasury yields from this past Friday versus the previous week. Here we have all the maturities that the Treasury issues at auction. Here's where yields stood this past Friday, and here's where yields stood at the end of the previous week. And here's the increase or decrease in rates over the past week. All Treasury yields were essentially up for the week, with the 3 months drop by 1 basis point providing the single exception that confirms the rule. And we weren't too surprised that longer dated yields continued to go up, as they did the previous week, despite the Fed rate cuts. As Marcus explained in this video here, linked below in the first pinned comment as well, this is not as unexpected or counterintuitive as it might seem at first glance. As long as the markets believe that these Fed rate cuts will stabilize the economy without creating runaway inflation and save us from a recession, long-term yields may go up on the assumption of this continuing growth and possibly even lower the likelihood of additional rate cuts. And that's exactly the picture that we saw this week again. Torsten Slok, the chief economist of leading alternative asset manager Apollo, published this chart on Tuesday that the U.S. consensus recession probability 12 months ahead is declining. And economic growth for the second quarter was revised up from an already not too bad 3.3% to an even more impressive 3.8%. At the same time, and again as expected, inflation remains a bit higher than the Fed's 2% target. This week's PCE, or Personal Consumption Expenditures Price Index, was up 2.7% overall and 2.9% for the less volatile core index. This is slightly lower than the inflation reading from the competing CPI index, which came in at 2.9% and 3.1% respectively. But still, you get the picture. Now, this somewhat rosy picture of an economy that keeps growing while inflation is a bit higher than the Fed would want to, but by no means out of control, could change anytime, of course. And the market is somewhat nervously watching out for all potential risks and pitfalls that could disturb the current balance and bring us either a recession or much higher inflation, or in the worst case, even both, the much dreaded stagflation. And there are quite a few of these risks out there. For starters, we may be headed for a government shutdown as soon as midnight this coming Tuesday, September 30th. Now, our treasuries wouldn't be directly impacted as this is a budget crisis, not a debt ceiling crisis. And if you want to refresh your memory about the differences and whether this type of government shutdown might even offer an opportunity to pick up some treasuries at higher than expected blip yields, I've linked our video on the topic below as well. That said, perhaps there are some skittish investors who are temporarily shying away from T-bills over concerns about our country's willingness and ability to service its debt during a shutdown. And maybe this here is that blip yield opportunity because the shorter yields generally do not go up like this after the Fed cuts rates. As for the lammers, we like our blip yields. Our 4-week T-bills auto-rolled this past week, and this investment rate is the highest it's been in weeks. As I always say, I don't have a crystal ball, and markets can change direction at the drop of a hat or the release of a bad inflation or jobs report. But at least we have a hypothesis here at Diamond NestEgg that has been working so far about what's going on in our markets and our overall economy. Now, let's take a look at Treasury yields from this past Friday versus the beginning of the year. This row shows where rates ended this past Friday. This row shows where rates were on January 2nd of this year. And this row shows the increase or decrease in rates in 2025 so far. And despite the increases this week, the yields across all maturities are still down versus the beginning of the year, and especially in the middle of the range. That said, yields are still at attractive levels compared to the past 2 decades, in case you're thinking about locking them in now, especially if that lets you sleep well at night, or if you're pursuing a strategy of dollar cost averaging to build your bond ladder or portfolio. As I said before, no one can predict the future, and especially if we were to experience a recession, rates would almost certainly come down again. You can find more details on these rates for any day of the week that the bond market is open on the Treasury's daily Treasury par yield curve rates page. All sources are linked below in the first pinned comment. Keep in mind that this overview gives you a general feeling for where rates currently stand along the maturity spectrum. The yields that you may get when you buy at a specific auction or from a specific broker, or when you sell, will likely differ a little bit from what's shown here. So, now that we know where Treasury yields ended the week, let's move on to the next section of today's video. What are the expected yields for the upcoming week's Treasury auctions? If we go to Treasury Direct's upcoming auctions page, we can see that all the weekly T-bill auctions are happening as usual. The 52-week T-bill will also be auctioned off this coming week. Other than that, it's pretty quiet on the Treasury auction front, with no T-note, T-bond, or TIPS auctions on the schedule. At the time of this taping, on Fidelity's platform, here's where the expected yields stand for the T-bills that have been announced already. Keep in mind that all of these numbers can and usually do change all the way up to the time of the auction. Drop a comment below and let me and the community know. What are you buying right now? CDs, Treasuries, or something else altogether? Curious minds want to know. All right, members, super savers, and course fans, I hope you enjoyed today's video and learned something new. And don't forget, if you want to take advantage of the current attractive bond rates before they potentially come down, then check out this video here on our bond courses. I've also linked all the details on our bond courses and our YouTube Super Saver membership below this video for your convenience. And see you again very soon with more brand new wealth building content for your financial journey.